Our country is undergoing one of the largest financial shifts in your and my lifetime, and at the heart of this shift is the Federal Reserve. So let's dive into the repercussions of interest rate changes made by the Feds and its impact it has on various asset classes such as stocks, bonds, and real estate. Now, the era of low interest rates is coming to an end, leading to a cascade of financial concerns and an economic crisis. And I think it's imperative to take a moment and make sure that you understand what these concerns are and the alerts that are going off so that you could potentially benefit from them. Now, before I jump straight into this topic, if you are someone who takes your investing and finances serious, make sure to hit that like and follow button so that you can be the first to be informed on these topics as they are now changing week to week. All right, so let's go ahead and get back. Now, let's first talk about the Fed's changing role in maintaining the economy. Now, the Federal Reserve has been the cornerstone in the financial markets for years, often acting as a safety net for asset prices through various monetary policies, like lowering interest rates and quantitative easing. But now the Feds are pulling back its support, signaling a paradigm shift. This is a big deal because the Fed's policies have long been the central place for guidance for investors. This transition period is like sailing in uncharted waters. Investors can't rely on past strategies that they banked on in the past, and the Fed's support is not like it used to be. This change could lead to increased market volatility and uncertainty, making risk assessment much more complex than it has been in the past. So how does this impact bonds? Bonds are often considered a safe haven investment, but the current scenario is changing this notion. A decline of 15% in US bonds coupled with a 20% rise in consumer prices is very concerning. It erodes the purchasing power of the returns from the bond. The potential for a 10-year US yield to hit 5% could further drive investors away from bonds, leading to a liquidity crisis in the bond market. Now, this is not just a US problem. It's a global issue affecting everything from government financing to corporate debt. So then what's the impact to the stock market, you might ask? Well, the stock market is also feeling this heat. A 10% nominal loss might not sound catastrophic, but when you factor in a 20% loss in purchasing power due to inflation, the real damage becomes apparent. And this could lead to a bear market where the downtrend feeds into investor pessimism, creating a vicious cycle. Now, it's a wake-up call for most investors to reevaluate now their portfolios and possibly diversify into more stable and alternative assets. Now, let's talk about the real estate dilemma. The real estate market, often considered a good long-term investment, is also under stress. The jump in the 30-year fixed rate mortgages is nearly 8%, and this is significant, a huge significant barrier for new home buyers. And this could lead to a stagnation in the housing market, affecting not just individual home buyers, but also industries related to real estate, like construction and home improvement. Now, the ripple effect could be substantial, slowing down one of the key engines of the economy. When housing costs eat up a significant chunk of earnings, consumer spending in other areas is likely to go down. This could lead to lower business revenues, layoffs, and a potential recession. Now, the stagnation and decline in the housing market is a symptom of a larger economic problem that will have a ripple effect in correlated markets affecting supply and demand for materials and certain jobs and industries. Now, lastly, the US debt and financial distress is something that I want to talk about. The issue of national debt is like a ticking time bomb. At $33 trillion, refinancing this debt at higher interest rates, well, is impossible. It's not just the government that will be feeling the pinch. Higher interest rates could make loans and credit more expensive for the average consumer, leading to a decrease in spending and saving. Now, this could create a cycle of financial distress that's going to be really hard to break. We are heading into uncertain terrain with the Federal Reserve changing stance in monetary policy, and obviously this is what's at the heart of all of it. From bonds to stocks to real estate, no asset class seems to be immune to the repercussions. The looming economic crisis, exacerbated by skyrocketing debt levels and stagnating housing market adds another layer of complexity to an already volatile situation. But we are also here to keep you updated on these new trends. This is not a time to be passive or lazy. My personal friends and family who were in the last crash lost it all during this last time. And I'm committed to make sure that this doesn't happen again to my friends, my family, but also those who follow my channel. So thanks for watching. Stay tuned, and I'll make sure to keep you updated on more topics like this. Thanks.